morning. My name is Dr. Lanisha Mako Ridley. I am the co-project director for the New Jersey Family Engagement Hub. I'm here this morning to kick off our series that we're co-hosting with Mass Mutual, From Piggy Banks to College Funds, Raising Financially Savvy Kids. This is part one of our series, and we're going to be doing a financial wellness overview. So before we get started, let's meet the team.
Good morning, everyone. My name is Kim Rivers, and I am the training coordinator for our statewide family engagement hub. I thank you all for joining us, and I'm going to pass it over to Tara.
So Tara is not with us today, but my name is Faith Victor. I'm the Northern Regional Family Engagement Specialist. I'm excited to be here. I hope you all enjoy. And now to Evan.
Good morning, everyone. My name is Evan Hardy, and I am the Central Regional Family Engagement Specialist. I am so pleased to be here, and now I want to pass it along to Alexis.
Thank you, Evan. Good morning, everyone. My name is Alexis Pratt. I'm the Community Engagement Specialist for the New Jersey Family Engagement Hub, and I'm going to pass it to Stephanie for introductions.
Hi, good morning. My name is Stephanie Babbitts, and I am a coordinator on the Statewide Family Engagement Hub, and I work with parent groups under START. I'm glad to be here, and I'm excited for the information we're about to hear. I'm going to pass it over to Kayari.
Hello, everyone. My name is Kayari Tyler. I am the virtual event support specialist for the Family Engagement Hub, and I will pass it over to Casey. Thank you very much for coming.
I'm Casey, and I am the coordinator for the Parents as Champions for Healthy Schools on the Family Engagement Hub, and I will be passing it back to, I believe, Lanisha.
Yes, thank you so much, Casey. So let me tell you a little bit about the New Jersey Family Engagement Hub. We are a centralized information hub for educators, families, and community partners. We work with these constituencies to create collaborations and build bridges on all things family engagement. We do this by providing tools and strategies such as our in-person workshops and our online virtual offerings. We also work with these constituencies to empower our youth. We need to know what our youth need so that they continue to be successful both in school and out of school. And now I'm going to turn it over to Kim to talk a little bit more about SPAN.
Thank you, Lanisha. And so SPAN Parent Advocacy Network, that is our umbrella organization. And SPAN is the parent center for the state of New Jersey. The mission of SPAN is to empower families and to inform and involve professionals and anyone who is interested in the healthy development and education of children and enable them to become fully participating and contributing members of community and society. So in order to do that, we have over 45 programs. It covers everything from health, mental health, human services, juvenile justice, child welfare. We extend to over 40 national, regional, and local programs and are funded by government agencies, foundations, and fee-for-service contracts. So I encourage you to go check us out on our website, spanadvocacy.org. And now I'm going to pass it over to our facilitators today, Christina and Chris.
Hi, everyone. Thank you for coming. We appreciate you taking the time out of your day to hop on. As Kim mentioned, my name is Tina Zappi. We're over at Mass Mutual in Warren, New Jersey.
Myself, Chris Hernandez. Nice to meet you guys or see you guys. Thanks for having us.
You can go to the next. This is just a disclaimer before we hop into it. As you saw the title of the presentation, this is one of a many-part series with an undertone of financial literacy, but this is just stating, again, this isn't specific advice for individuals, it's more high level. We'll get into down the line the opportunity to meet with us to discuss your individual situation in more detail to give guidance on that. But again, this is a high-level overview and the first of many. You can go to the next. So what the overall goal of these workshops is to really dive into what it means, what is financial well-being, what does that mean, how do we achieve it, etc. This is at a very high level how we go about defining that. First and foremost is really having control, whether that be day to day, month to month, etc., but having control over those finances, knowing what's coming in and out and what you're doing with that surplus. Two, it's the ability to take on or absorb financial shock. So what that would mean is anytime we see volatility or change, whether it be the markets, economy, etc., that we have a plan or a foundation in place that we're able to withstand that. Three, being on track to meet financial goals. Some of these can be buying a house, paying for college, retiring. I could go on, but overall having your goals set and knowing where you're at in terms of progress. And then lastly, this is a term that's thrown around a lot, financial freedom, and wanting to achieve that to be able to enjoy your life however that may be. This term is thrown around a lot. How we define this is having the financial foundation that if you were to stop working, it's not that you need to, but that you have the ability to, and to be able to generate whatever income it is that you need off of the assets and things that you've developed in the background. You can go to the next.
Awesome. So a little bit of the agenda for today. We're going to talk about savings, different saving strategies, little tips on how to save. We'll touch on investing, right? How should we be investing? The 101 on investing. We'll talk about protection, right? Protecting yourselves, your assets, those things that are most valuable to you. Retiring, right? Hopefully we all get to the point that we can retire comfortably, like Tina said, and having the ability to choose to work full-time, part-time, or not work at all. And then lastly, estate planning, right? One day we're going to move on, and we want to make sure that everything we've worked so hard for is passed on to our loved ones as efficiently as possible. And so let's start with savings, right? And, when we talk about this is just a general rule of thumb as a minimum goal, right? Consider setting a savings goal of 10% of your monthly net income, right? We always say you got to pay yourself first, right? So every month, set a goal. Hey, 10% of my income is going to go towards saving, and you can allocate this money towards different things. The first one I say that everyone should have is an emergency fund, right? We talked about absorbing financial shock, right? When it comes to financial well-being. Well, a flat tire on the car, your car doesn't start. It's been cold out, right? Maybe the battery on the car goes bad and that has to be replaced, right? So having an emergency fund is so key to being able to be put in a good financial position, right? From there, though, there's other things we want to plan for, right? Large purchases. Maybe that's a new car, a home, maybe it's a vacation, right? Retirement savings, right? At the end of the day, retirement is a little bit ways out for some people, and some people maybe you're on the doorstep of retirement, but it's important to be saving early and often for your retirement, because when you think about it, you start working, let's just say right out of college at the age of 22, and you work for about 40 years, 43 years till the age of 65, and to be retired for another 30 years is not uncommon anymore, right? Getting to the age of 90, 95 is something that we're seeing more and more often. We're even seeing people into their hundreds. So how do we make sure that we could spend all those years without having to go back to work? And then lastly, it's college tuition, right? Education in this country is very expensive, and really being able to plan effectively for college tuition is important, and saving early for that is important as well. Right, so here's some little tricks when it comes to saving. Make it part of your monthly budget. Hopefully everyone on this call is keeping a monthly budget. And when people hear budget, a lot of times they take budget as a negative term, or, oh man, I gotta be worried about where I spend money. And it's not meant to be worried. It's really, budgeting is meant to allow you to have the freedom to spend money where you want and save money where you want. So consider savings to be a fixed monthly expense. I always say, if we're paying rent or if we're paying our mortgage, we don't really think about if we can or should pay that on a monthly basis, right? We're going to pay our rent on time, hopefully. We're going to pay our mortgage on time. Of course, things come up. Same as our credit cards, right? We have that minimum payment on our credit cards, and we don't really think about missing that minimum payment, right? Why? Because our credit score gets impacted. There's adverse effects to that. Now, when it comes to savings, we don't really see that impact till we need that money way down the road. Right. A great trick is pay yourself first with automatic savings options like direct deposit. So if you have retirement accounts through work, right, 401ks, 403bs, TSPs, Those are things that come right out of your paycheck and allow you to save before you even see the money, right? It helps with the discipline of saving because it doesn't have to be put into your bank account first and then give you the option of whether you're going to save or not. And then lastly, use a combination of income and reducing expenses to reach monthly savings goals. So I always say if there's the opportunity to work overtime or if there's opportunity for a job, a change in jobs that can give you a pay raise, right? That's one way to help you be able to save. And the other one is reduce the expenses. And reduce the expenses can be something simple. I can't tell you how many times I come across families that didn't realize that they have 2 Amazon Prime subscriptions or 2 HBO Max subscriptions, or they're paying for a subscription that they haven't used in a year and a half. Well, let's look at those things. And through budgeting, we should be able to help reduce those expenses and free up money to save more. Now, here's just an example of how important it is to start saving early and often, right? If we look at the black line, blackish blue, I think it comes up as black on most screens. What that is shown is that's shown a 22-year-old that said, hey, I was able to work through college, or I have $10,000 that I can set aside. And they decide to set that aside into an account that gets them a 5% compounding interest every year for 48 years. And at the end of those 48 years, by the age of 70, that individual saved $10,000 and they have upwards of $100,000. Okay. Now, let's look at what happens to the individual that says, hey, I'm going to wait. I'm young. I don't really need to save right now. And they decide to put off savings until the age of 40. Now, at 40, life has gotten busy. They got kids, maybe. They got a family. They got homes. They got car payments. And they say, you know what? The best I could do is save about $125 a month right now for the next 30 years till the age of 70. And they're going to get that same 5% compounding interest every year as that first account I mentioned. And what we notice is that 40-year-old saves over the next 30 years $45,000. And their $45,000 grew to just about the same amount as that 22-year-old that put $10,000 in and never saved again. Right? I think for most of you on the call, you'd rather be the person that saved $10,000 to have $100,000 than the person that saved $45,000 to have $100,000. Right? So this is just showing how important it is to take advantage of compounding interest early on. The earlier, the better. Every dollar counts, especially if we have time on our side. Right? So, ultimately, it's really important to strike a balance between paying down debt and saving, right? Debt can be catastrophic, right? Especially high interest debts like credit cards. Those are something that we want to focus on paying down. There are other things like good debts, right? I call good debts mortgages, student loans potentially. And those debts typically have a much lower interest rate attached to them. And it's important, instead of just worrying about paying down debt, it's a matter of creating a plan that you are able to pay down your debt, but start saving at the same time. Now, once we've built up that emergency fund and we've gotten into the habit of saving and the discipline of saving, it's always great to start investing your money, right? And investing is a great way to put your money to work for you, right? Now, understanding the risks involved with investing is very, very important, right? Because at the end of the day, you can lose money when you're investing. Just because you put $1,000 in doesn't mean it's going to be on the up and up all the time. We see times in the markets that things go badly. 2022 is an example of when the markets were, didn't perform very well. We can keep going back to 2008 and the housing market crash, and the markets crashed in 2008. We can go back to the early 2000s, to the dot-com bubble, right, where we had 2-3 years of consistent down years in the market. So it's really important when you're investing to know why you're investing. What is the purpose of the money I'm putting away? The next one is be realistic with your expectations. If you're expecting your money to double overnight in the stock market, we really should sit down and understand, do you have the right expectations? What are you investing in? And what risk does that come with? And I think understanding your risk tolerance is key to being able to put your head on the pillow at night and go to sleep calmly, right? At the end of the day, we have ups and downs in the markets on a day-to-day basis. And like I said, we've had bad years, but we've also had a lot of good years in the stock market, right? And for the most part, if we look at large periods of time, right, a 10, 15, 20-year period of time, the markets do trend upwards. So it is important to plan for the long term and not expect money to double overnight. When it comes to risk tolerance, here's just a little chart to give you an idea of what that looks like. On the left, we have someone that's super, super aggressive. And you see that circle graph, that circle chart is made up of cash equivalents, equities, and bonds. And what does that mean? So the light blue equities, right? Those are your companies. Those are things like Apple, Microsoft, Google, Amazon. Those are your companies that you can buy. Your S&P 500, your NASDAQ, right? These are companies that you can actually purchase ownership in those companies. A very, very small piece of ownership, but you are now partaking in the growth of that company. Now, equities typically have the most risk attached to them. We typically see the most ups and the most downs with equity markets. So as you look from the left all the way to the right, as you get more and more conservative, you hold less equities in your portfolio. Now, bonds, as you see all the way on the right in green, bonds starts to build up more of that conservative portfolio. Many of you may have heard what's called treasury bonds or treasury bills. You may have heard of corporate bonds. And bonds is really a much safer investment. It's really debt. You are lending money to a company or to the government, and they were promising or agreeing to pay you back with a set interest rate, right? Typically, these interest rates are not comparable to what we see in the equity markets, but we don't see as big of swings on the downside and the upside in these accounts. And cash equivalents might be just savings, money markets. It's always good to have cash on hand because cash gives you the power to buy, whether it's equities or bonds, during times of opportunity. When the markets are down, it's typically a good time to buy, right? I always use the analogy as if you have a favorite store and that store says it's on a 50% discount, right? Are you going to go try to see if you find anything at the store? The likelihood is yes, especially if you need something, right? I know that I'd love to go shopping at my favorite stores when it's always on a discount, right? It's the same thing with the stock market. When there is 20% drops in the market, that is your opportunity to potentially buy at a discounted rate from what it was prior, right? At the end of the day, it's a risk versus reward. The more risk you take, the more potential for reward. The less risk you take, the less potential for reward. And understanding how comfortable you feel with risk is an important thing to think about when investing your money. Right. You know, the next thing that's important is not putting all your eggs in one basket, right? You've probably heard that saying before. And I always use an analogy of an elevator. Right? If we were on a field trip to the Empire State Building and there was two elevators, an elevator on the right was going really slow. And when you ask, hey, why is that elevator so slow? They say, well, that elevator has 100 cables and it goes a little bit slower because of all the cables. But if one cable snaps, you're not going to come all the way crashing down because we still have 99 cables pulling us up. And then there's the elevator on the left. There's no line. It's going up and down super quick. And when you ask, hey, why is that one moving so much faster? They said, well, that one's set up on a one cable system and that allows it to go faster. But the risk is if that cable snaps, that elevator's coming all the way down, right? Obviously a pretty crazy thought, but if you had to pick what elevator you're picking, I'd like to think most people, maybe we have some risk takers on the call today, but most people are taking that elevator with 100 cables to make sure that they get to the top. And that's the same thing when it comes to investing, right? Diversification helps mitigate losses or helps offset potential downturns. If you own 100 different companies and one company goes bankrupt, you still have 99 companies that your money's invested in, right? If you own one company, and let's just call that company Microsoft or Apple, and that company goes bankrupt, right? We saw it with Lehman Brothers in 2008, right? There are great companies, super reputable companies that have gone bankrupt in the past, right? If that company goes bankrupt and all of your money's in that basket, you're going to lose all your money, right? So diversification is really great to help manage risk over the long term and make sure that your money is not exposed too much to the risk of one company. You know, some other things that are not necessarily stock market related. We do have the College 529s that are stock market related, and these are college specific savings vehicles that allow us to invest for college, grow our money tax deferred, so we don't pay tax on our money while it's growing. And as long as we use it for qualified education expenses, we get to use that money tax free. Another great form of investing is real estate, whether it's your primary home or maybe even rental properties where you can start to collect an income from it. So I'm going to toss it over to Tina. You know, one thing I will finish on, saving and investing is super, super important. But at the end of the day, protecting everything we've worked so hard to build becomes a really, really crucial part of building the foundation of your financial world. So I'll throw it over to you, Tina.
Yeah, so as Chris mentioned, obviously there's a lot of pillars when it comes to the, really planning out your life and making sure everything is in order. And sometimes people overlook the protection side of things. What does that mean? Well, there's a lot of different areas where we do this. One can be your car. I know everyone's talking about car insurance, especially in New Jersey, the pricing, all of that. But essentially, what all these means, whether it's home insurance or anything in terms of when you're renting an apartment to protect your property, the overall goal is to put protection in place. So if something did happen that had a much larger cost than we'd have the appetite for, depending on what these assets are valued at, that we have protection in place to help us with those costs if needed in the event that it's needed. So there's all different areas that we'll touch on where you can find this protection. But again, it's really important to have these in place, because if you're saving and investing and you don't have overall umbrella protection around that plan or around that foundation, it takes one event to just throw it out of whack. So first and foremost, we like to start on things that people usually get through their employer. So here, the overall message is it's important, if you have the option to get health insurance, get it through your employer, or if not, on the market. Again, one event, especially when it's related to health, can have a huge consequence on that plan, that foundation that we discussed. So there's different options that you have. There's usually a contact at your employer when you're enrolling that can help you make a decision, whether you're independent, you have a family, different situations, what might make sense. We strongly encourage, one, to get this in place if you have the option, and two, utilize your employer resources to help make an educated decision on which plan is best. So two, life insurance. This is something that you can usually get either through your employer, or depending on the coverage that's needed, you can get individually for yourself. So first and foremost, as mentioned with or related to the health insurance, life insurance, and it's typically not overall coverage, but you can usually get small amounts through your employer depending on where you work. We strongly suggest going into your benefit booklets and seeing if they do offer, whether it be, usually it's term insurance or a small amount, depending on, again, what those benefits look like. But when we look at life insurance and what this does, there's going to be two different options that I mentioned, and I kind of hinted at one. First is going to be your term insurance, which it is what it sounds like. Term, I always say, think about renting an apartment. You have a period of time in which you're paying for that coverage. If you use it during that period of time, then, obviously that could be a couple of years here and there, then it'll be in place. If not, then you lose that protection afterwards. So let's say term insurance, you get a common one when you're younger is 30-year term insurance. So for 30 years, you're protected at X amount of coverage that you purchase. If, again, something happens within, then you get that coverage. But if you go past the 30 years not exercising the coverage, then you lose it. So this can be great, and it's more cost effective to cover things like your mortgage, cover things like an estate plan that we'll get in down the line. But again, it's more temporary and allows for you to get extra or additional protection at a lower cost for those milestone expenses throughout your life. The second type is permanent insurance. Oh, sorry, if you don't mind going back. The second type is permanent insurance. And we want to make sure people know the two, because permanent is exactly what it sounds like. It's insurance that you purchase now that you have for the rest of your life. So this can be really important in two cases, but more importantly, people think around the estate planning, you're always going to have that coverage. And more importantly, say you think about term versus permanent. Term, say you go through X amount of years that you had it, but you still need coverage afterwards. You're going to have to go through underwriting, which essentially is related to your health, to see if you can get this protection. With permanent, it's once now you get underwritten. If you get approved, again, you're going to have that protection throughout the duration of your life. So a second value add of the permanent side, unlike term, is you are going to have a cash value bucket within that policy. All that means is down the line, as it grows, it's similar to a mortgage. You're paying the interest or cost up front. But as you get throughout a couple of years from when you put this in place, you're going to see a nice cash value bucket building within this policy. So you can actually pull out or loan against this cash value throughout your life to use it for certain expenses. So there's pros and cons to either one. We usually see people use a blend of both. And yeah, you can usually get a very small amount, but some amount through your employer. But a lot of this will be on the quote unquote individual side where you're purchasing this for yourself to get the coverage you need. The second one that, again, you can get with your employer and then also go on the individual route is disability insurance. This is a blanketed statement. It can depend from employer and employer, and we strongly suggest you look at to see what coverage you are given at your own employer. But we typically see that employers offer around 60% coverage through their given disability policies. So what does that mean? Typically, let's say if you make $100,000 and you can exclude the bonus here, so usually this is just on the base amount, that the employer will cover up to around 60% of whatever your base salary is if something were to happen while you're employed with them. So in that $100,000 case, that would be around $60,000 of coverage. Again, it's going to depend employer to employer, so we suggest that you look at it for yourself individually, but that's what we see from a general standpoint. So that would be, again, your group long-term disability that you'd see that you get through that. On the flip side, though, a lot of people do purchase disability insurance for themselves individually. And there can be like two scenarios. One, as I mentioned, 60% of your compensation or only base salary is usually covered through your employer. So a lot of people, when they look at the math and their plans, as we mentioned, what they're saving, what they're investing, what they're on track for their financial goals, 60% of that income that they have or salary even isn't enough to keep up with that plan. Therefore, a lot of people will look at putting in place private plans or individual plans for themselves where they get additional disability coverage. So again, in the event that anything would happen, they can usually up that percentage of their compensation and include some bonuses and things depending on how your compensation is structured to make sure you have that added layer of protection to ensure your plan keeps going no matter what like life really throws at us. Something that we see where this can be really important is especially if there's a single provider in the family. Again, in any event, it's going to be significant to whatever foundation and plan you have in place for you or your family. But especially when we're relying on one income, it's really important to ensure that you have that ability to bring that income in protected, because if that goes away, all these other pillars that we're discussing in the plan, they don't really matter if nothing is funding them. So to kind of wrap this up, and there's two more topics on the goals and the things that we're doing with what we just described, which no matter who you are here, whether you plan on retiring or not, we want to ensure that we're striving towards the ability to do so. And what we find when we meet with a lot of people is there's some things people don't necessarily think about what retirement looks like. So when you think about this overarching idea, and the earlier the better, we always want to stress that there's a couple things you want to think about. Where do you want to live? Where do you want to be located? What does that look like? Whether it's a house, condo, etc. How are you going to be spending that time? What activities, what hobbies? Again, that could be maybe doing a passion project within retirement where whether you're bringing in income or not, it's important to consider that when you're starting to plan for retirement. And lastly, how long it will last. Why it's so difficult to plan for retirement is we don't have a crystal ball. So we don't know how long all of us are going to need to be able to generate our own income. So while we're not able to necessarily see the end, we want to start planning on when statistically are we shooting to be able to do so with our savings and investments generating or replacing the income that we're making right now as, say, a business owner or employee. And again, this is very general stats, but where we see a large amount percentage going into retirement in terms of expenses. So this is typical. Housing is going to be a larger expense, and we're seeing it become even more, I don't want to say expensive, but a larger chunk down the line. If you do need to go somewhere where, say, there's more assisted living options, whatever it may be. But housing, nonetheless, as it is usually now and in the future, is going to be the majority of what that expense looks like in retirement, being around 35%. Then some of the other areas that we want to put on the radar for people is transportation, whether that be yourself or down the line public or even assisted again as we get through retirement. And a larger one that we're seeing continue to increase is healthcare. What we're seeing, while we're not only living longer, we're living longer with certain conditions or whatever it may be, which is great. That means technology and science is continuing to move or advance, and therefore we're able to live with certain conditions. But there are usually a cost to deal with whatever those symptoms or aid that we might need to put in place. So this is a big one. We're seeing it to continue to uptick as we go on life expectancy and then cost there. Another one, and these are just quick ones, obviously food, entertainment. We'll see entertainment, we say like the go-go years, right? When you retire, that's when people want to travel, get into their hobbies, etc. And then some of those can taper off as you go. And why we want to look at the expenses is these are all the things we want to consider so we can figure out what is that income that we need to be able to retire, to have the ability to do so. And once we get to that number of, okay, we need X amount of money to cover all those expenses I just reviewed, we now need to start to look at what streams are we creating to be able to pay for that, to pay for those expenses. One that's a hot topic for everyone is Social Security. A lot of people have questions on when should I take it, how much should I assume in my plan, and those are questions that are usually specific that we can answer offline with people, as it depends person to person. Two, which we're seeing is not as common, which is why retirement is such a topic of conversation, are pensions. A lot of people, if you have someone that was in any government-related job or even some of the bigger companies down in the past, pensions were basically, rather than a 401k, after you gave X amount of years of service to an employer, they would promise to pay you X amount every month, to the day that you pass. Therefore, retirement was a lot more stable because it wasn't individuals having to create the bulk of their monthly or yearly income while they're in retirement, which we now know some people still have these and can utilize them, but a lot of the times we're seeing people use other vehicles to make up for this income that they used to have access to. Which brings me to personal savings. So this can be things like your 401k, savings account, individual investment accounts. These are all the things that have become more important because, again, we have more of a responsibility as society goes on to create this income for ourselves. So it's important that we look at our personal savings and we're not just relying on Social Security, as we're seeing time and time again. It's not very close to those expenses that we just reviewed, and people tend to rely on that too much without doing these projections to see that there is a gap that we're going to have to fill with these personal efforts. And retirement accounts, as I mentioned, kind of tie into those. And lastly, annuities or fixed income options, and there's different kinds of them, where this essentially is you give a certain amount of money to a company, and similar to a pension, they're going to promise to kick off X amount to you monthly. So it's a different way to create, we like to say, like a private pension for yourself. While it's not one, it acts as such where you're giving a lump sum in, and then you're seeing that income come in again to the day that you pass there. There's a couple other sources of income as well, but the overall message that I want you to take away is a lot of people don't think about what their need is when it comes to retirement income. They never think of a number. They never really think about how they're going to do all of this once they do retire. They're usually just shooting to a number and they don't know what's going to come out of it. We strongly suggest you really put some time into thinking about what are you shooting towards and how are you going to generate this income when you're retired, and don't wait until you get there and you're staring at it. So again, this touches base back to the slide that I just went through. We like to break out how we look at retirement into a 4-box strategy. So on the left, you're going to see the income sources, and then on the right, you're going to see the expenses that are typically tied to them. And what you're going to see, the overarching theme is our necessity expenses, or the things that we can't sacrifice on. We want tied to income streams that we know are reliable. We don't want the market or outside factors to decide whether we can afford the needs within our lives. However, you'll see on the bottom, those non-essential costs, that's where we're using those different streams of income where maybe they are tied to the market. And as Chris alluded to in his section, there is variability to them, but there's opportunity for growth. So if we look at the left here, you're going to see some of the categories that I mentioned: Social Security, pensions, income annuities. These are reliable and predictable sources of income that we want to use when we look at the necessities such as housing, food, healthcare. Those aren't things in our retirement that we want up for debate on whether we can afford. So that's why we always say these groups or these types of incomes are great to ensure that they'll cover these expenses. On the bottom, you'll see stocks, bonds, cash, the things that Chris mentioned when he went through the investment section. These are streams of income that are less predictable and may not be sustainable in the way that you don't know what income you're going to be able to generate from them if your balance in these accounts is variable based off of the economy. So that's why we like to tie these or use these to fund the expenses such as travel, as hobbies, which are great and things that we all want to do in retirement, but again, aren't necessities. So it's just important to think about how you're generating income and making sure that, especially on the necessity side, you have that guaranteed or stable income that you know is coming in where you can at least cover those expenses. So yeah, I'm going to throw it to Chris. This is kind of the last wrapping how we're going to be planning throughout life and on to the next as we get there.
Yeah, so obviously we hope everyone has a long, exciting retirement, gets to do everything they want to do in their retirement years. But at some point, our time here is done, and that's where making sure that your estate plan is in place and is important, right? Estate plan is important to make sure that everything that you've worked so hard for throughout your life is transferred on after you pass away in the most efficient way possible. So some things that can help make sure you have the right estate plan established. One is establish beneficiaries, right? Your 401ks through work, retirement accounts in general, investment accounts. Make sure that there's beneficiaries of them. Same thing for life insurance. If you have life insurance in place, who is that beneficiary on that account if something happens to you? The next one is try to minimize taxes, right? Understanding what money is going to get taxed, who it's going to get taxed to, right, is really important when creating a estate plan. And again, let me reiterate, we are not estate planning attorneys. This is where it's very important to work with an estate planning attorney to make sure that you have the right documents in place, right? These documents can help ensure a smooth transfer. And lastly, limit probate, right? Probate can be a daunting task, a daunting process dealing with the court system. And really, we want to make sure to avoid that as much as possible when you're trying to pass on your assets. So some key tools, some key documents that everyone should be looking at. Your wills, right? Do you have a will in place? Have you sat down with an attorney to make sure that your will is, one, up to date if you have one, or two, if you don't have one, making sure you have one in place. Looking at trusts, right? Do trusts make sense in your family's financial situation to have assets going to a trust, right? Now, a lot of people think trusts are only for the super, super wealthy. That's not always the case. There's value in trust for many families. It just depends where you are in financial situation, right? So I don't want to dive too deep into it because I don't know where everyone falls on this call today, but trust can be a good thing. Gifting, right? Let's just say you're older in age, you have grandchildren, you have great-grandchildren, maybe you have your own children, and you want to help make sure that they're taken care of financially, right? Potentially gifting money out of your assets to them before you pass can help with taxes and passing on those assets efficiently. And lastly, life insurance. Life insurance is a great tool for generational wealth, right? If you pass away, life insurance is typically a tax-free benefit to whoever the beneficiary is. And many times it is on time and it is not attached to creditors, right? So that is an important factor as well. So, I know we talked about a lot today. I will say there's follow-up opportunity to ask questions on your personal situations. We talked a lot about savings, investing, how to protect yourself, retirement, and estate planning. But at the end of the day, everyone's financial situation on today's call is going to be a little bit different, and we understand that. So we offer free one-on-one consultations to anyone on this call today. And if you want to go to the next slide. right? You can scan that QR code with your phone, schedule time directly with Tina and myself to ask us any of your personal questions that you have regarding your finances or anything we talked about in today's presentation. I want to thank SPAN for having us here today and allowing us to present to you guys. Thank you so much for the partnership with your organization, and look forward to doing more of these throughout the year.
And I know we
Thank you so much to Chris and Tina for their presentation today. And we are going to take a few minutes to just do a quick survey. So we invite you all to scan the QR code and take a moment to take our short survey. Your feedback is essential in helping us to continue to deliver valuable and engaging webinars like the one we just had. Thank you for taking the time to complete our survey. And now this is our activity worksheet, the creative ways to teach about saving, budgeting, and making smart financial choices. It provides quick tips for families with children in elementary, middle, and high school. It's a printable document, and it will be provided to you in our Google Drive once you complete the survey. Part 2 of From Piggy Banks to College Funds Financial Goal Setting is happening on Tuesday, February 17th from 12 to 1 p.m. And again, Chris and Tina will be joining us. On Tuesday, February 18th from 3:30 to 4:30, we will be joined by Erica Britton from SEL for New Jersey, and she's going to talk to us about executive functioning, practical classroom tools. On February 23rd from 6 to 7 p.m., Patterson Education Fund will present Understanding the School Budget, which is part of their parent and community advocacy series. And then again, Erica Brenton will be joining us again Wednesday, February 25th. And this time she's going to talk to us on Calm, Restore, and Thrive, a well-being workshop. Our next monthly webinar will be on Tuesday, March 10th from 11 to 12 p.m. And it is titled The Academic Roadmap, a Family Guide to Curriculum and Standards for K-12 Education. All of these workshops, the registration links have been provided in the chat, and you will be able to access the flyers with the QR codes. Thank you so much for joining us for today's webinar. If you weren't able to do so already, please scan the QR code and fill out the survey. You will be able to select in the survey if you need a certificate of participation. Just choose yes or no, and we will send you that certificate. Please join us in following SPAN on our social media networks and visit the Hub website at njfehub.org. Please feel free to subscribe to our newsletter, The Engagement Exchange. We also have a YouTube channel, and the channel address is provided on the screen. Thank you so much for joining us this morning, and we hope you have a great rest of your day.